Hey, welcome back. Today we're going to talk about Chapter 5. And one thing I like to point out as we're starting Chapter 5 is that we've really covered everything in accounting already. The first four chapters in Accounting 1211 cover like basic definitions of assets, liabilities, and equity. We then learn how to do journal entries, and then we learn how to do adjusting journal entries, and then we learn how to do closing. We've done financial statements. We really covered everything there is. If you've made it to this point in the class and you're really kind of following along and you feel like you're doing okay, then I would encourage you to stick with it and keep up that level of work. What we're going to essentially be doing now, from now until essentially the end of the class, with just a couple of exceptions, is we're going to find a topic and then we're going to dig into that topic a little bit more. And so that's what we're doing today when we do Chapter 5 is we're digging into this merchandise piece of the puzzle, and we're going to just really get into it. We're really going to dive into the different journal entries from different sides of transactions and things like that. So specifically, we're going to be doing that definition of service companies versus merchandise companies. We're going to add a new account to our list, which is cost of goods sold. We're going to add a new term, which is gross profit. We're going to talk about perpetual versus periodic inventory systems. And then we're going to go through two sets of journal entries, a purchaser set of journal entries and a seller set of journal entries. And then we're going to finish up with just a really short note on the multi-step income statement. So as we get started, we're really shifting in this text and in this class. Up until this point, every company we've dealt with, whether you realized it or not, was a service company. Someone was selling a service, a law firm, a landscaping firm, something like that, a service company like UPS. And what we're doing is we're shifting in this chapter really briefly. In chapters 5 and 6, we're going to talk about companies that sell stuff, merchandise companies. And when we think about what's the primary difference between a service company like UPS and Target, which is a merchandise company, hopefully you figured out that main difference is inventory. It's the stuff that they sell. That's what really differentiates those two companies primarily, is inventory. Remember, inventory is stuff that a company buys to sell later to customers. New account, cost of goods sold. Hopefully at this point, you see up at the top where it says cost of goods sold, you see where it says inventory expense, and you know because it says inventory expense that this is an expense account which has a natural debit balance, and so you may not need to be you're not adding too much to your work at this point. And hopefully if you aren't to that point yet, you'll get there soon, because we really need to get there. We really need to go debits and credits down nice and solid. So we could just call cost of goods sold inventory expense, but it has a proper name. The proper name is cost of goods sold, which is an okay name because it's exactly what it is. It's the cost of the goods that we've sold. Again, like most of our accounts, it's telling you exactly what it is right in the title. Another new term, one you might be familiar with from just living on the planet or watching CNBC or whatever, is gross profit. And here's the definition of gross profit. Sales minus cost of goods sold equals gross profit. So gross profit is basically how much money a company makes doing its main thing, its primary thing. In this case, Target. It buys stuff and sells it. Well, that process, this is going to tell us how profitable it is at just that piece, independent of stuff like rent and payroll and all that other stuff. So let's talk a little bit about inventory relationships. This is super important for chapter 6. Why are we talking about it now? Good question. I think it's important to get to it twice, and so you're going to see this slide again when we cover chapter 6. But this very, very important chapter 6, and covered some in chapter 5 as well. So I think it's important to get to it here too. So this first relationship is super important. It's basically the definition of goods available for sale. Goods available for sale, again, it's telling you exactly what it is. It's all the goods that we possibly could have sold this month or in this period. And if you think about that, they really could have only come from two places. Either we had them when the year started, or when the month started at beginning inventory, or we bought them in this period. That's the only place these goods could have come from. So it's, again, pretty self-explanatory, hopefully pretty intuitive. And so the goods available for sale number helps us to get started when we talk about these inventory problems, which we're going to see more of in the next chapter. But we can take it further than that. If we take our goods available for sale number, which was a total amount of stuff that we had this month, and we subtract how much we had at the end of the month, then we found a number. And that number is cost of goods sold. So again, if we knew we had $1,000 in our goods available for sale, and we know we have $100 at the end of the month, then we know we sold $900 worth of stuff. Again, hopefully intuitive. Hopefully this is intuitive for us. This isn't a stretch for us. And we can also go the same way, which is if we take our goods available for sale and subtract all the cost of goods sold that we've had this year or this month, then the number that's left should be our ending inventory. Now, the only exception to these rules, and again, this is a minor point to be honest, there's a question on the exam related to this, is this concept of shrinkage, which is there's an expected amount we expect to have an ending inventory, but sometimes, and almost every time, a company goes and counts that ending inventory, they find those two numbers are different. Maybe they're different by $5, maybe they're different by $5 million. It just depends on how big the organization is and how well they control their inventory. That concept of the difference between the inventory that is the company expects to have and the inventory the company actually does have is called inventory shrinkage. What can cause inventory shrinkage? Well, hopefully you can think of the thing most students think of right off the top is that stuff got stolen. There's other reasons too, spoilage or damage to products. Fraud could be at play. An error can also cause shrinkage. If you enter an invoice for $10,000 instead of $1,000, that can elevate your inventory values, and then that actual will bring that down. So one note about worksheet 1 before you get started, there is a term I didn't cover yet, and that is the gross profit percentage, which is just gross profit divided by revenues. That's on that worksheet 1. It's not super important, but I do think it's helpful to kind of do that, and you can also find that formula in your textbook. So good luck, and don't forget to take a break when you're done with your worksheet. Work on your worksheet. Do something else for a minute so you're not just doing accounting and driving your brain crazy.